Hi viewers, and welcome again. Today, as promised, we'll be speaking about how you can make money using the stock market. In the previous video, I spoke about what shares are and how the stock market works. So if you haven't watched it, you probably should watch it before you watch this video. And as I always say, please let us know in the comments any questions you may have on investing, and we'll make sure that we do a simplified video on it so that everyone can understand how to make the different investments work for them. There are two ways that you can make money using the stock market, either through dividends, through price changes, or both. By the end of this video, you'll understand each of these methods. We'll begin with dividends. When you own shares, the company behind the shares may decide to share its profits with its shareholders through direct payments at various times in the year. These dividend payments are directly proportional to the number of shares that you own. So the more shares you own, the more money you make. I'll give an example of Williamson Tea, which is one of the companies that's listed on the Nairobi Securities Exchange. It currently gives a dividend of 20 shillings per share. So someone who owns 10,000 shares of Williamson Tea will attain 200,000 shillings when they decide to pay out a dividend, while someone else who owns 20,000 shares of Williamson Tea will get a payment of 400,000 shillings. Some companies do not issue dividends, but other companies are well known for issuing regular dividends on a recurring cycle, whether it's once a year, twice a year, or even more than twice a year. And some investors take advantage of this and hold on to these stocks long term because they expect these regular payments. However, as easy as it sounds and as lucrative as it can be, there's one very important thing to note, which is book closure. You'll hear this word being tossed around in investor circles, and now you can use it as well. This is the cutoff date for determining which investors on the record will receive a particular dividend payment. You will not get a dividend if you buy a stock after the book closure date. This is because companies have a register within which they note all the current shareholders, and after the book closure date, they are not willing to make any adjustments because it falls quite close to the date when they actually pay out the dividend. The second and regularly used way of making money using the stock market is price changes. The prices of stocks are always changing because they are affected by a lot of factors. This is why investing in the stock market can be risky and should be done with caution. Remember, as explained in a previous video, a share represents a virtual piece of a company. So if the company does well, your share will likely do well. And if a company does badly, your share will likely do badly. So when you buy a share, you share in the goodwill of the company or the success of the company, but you also share in the risk of that company. Some examples of why the price of your share would change include news of change in management, whether good or bad, change in the perception of the company by the public, new competition that reduces the profits of the company, or even a lack of innovation of the company for a significant period of time. And the list goes on. AIB has a team of experienced research analysts consistently monitoring these factors and using this information to regularly update our clients on which shares to buy, sell, or hold. Now the question is, how do I make money through these price changes? Well, it actually depends on what kind of investor you identify as, either a speculative investor or a value investor. A speculative investor is an individual who maximizes on the short-term price changes that the stock makes. Speculative traders actively monitor the factors I mentioned before, and depending on what direction they think the stock will take, they invest in the stock with the aim of buying it at a lower price than they will sell it at later. I'll give an example of a stock of a company that we are probably very familiar with, which is KCB. KCB was 44 shillings, about 44 shillings by the 28th of October. But during this time, there was the announcement that the interest rate cap was going to be scrapped. So a speculative investor would have been on top of the news during this time and would have noted this and anticipated a price increase of KCB. By the 1st of November, the price of KCB was 53 shillings and 25 cents. That's a price difference of 9 shillings. A speculator who bought, for example, 10,000 of these shares will now have made 90,000 within these 3 days. He or she would be doing this with multiple other shares as well. As you can see, this is very lucrative, but it can also be quite risky as the price can plummet unexpectedly and you'd make a loss on your shares. The other kind of investor is a value investor. One of the very famous value investors that you probably know is Warren Buffett. This investment strategy can be just as lucrative, but usually takes a longer period of time. A value investor looks at the particular company, looks at the fundamentals of this company, and comes to the conclusion that this company is going to do well in the future, regardless of what is going on in the market. So they'll invest in this company for a period of time, ignoring the various fluctuations that will occur because they expect an increase in the price of the stock either way. For example, if you believed in Safaricom as a company when it first issued its stock, you would have bought its shares at 5 shillings. Right now, they cost about 28 shillings per share. That's a gain of 23 shillings per share, not counting all the dividends you've received over the years. That's a value investor. So that's it for today. As usual, thanks for watching, but do let us know, what kind of investor are you? Are you in it for the dividends or the price changes or both? And if it's the price changes, do you identify as a speculative investor or a value investor? Again, do give this video a thumbs up if you enjoyed the content. Let us know in the comments what other topics you'd like us to tackle, and stay tuned for more simplified videos that will help you become a capable and profitable investor.